Okay, so let's talk about what's happening. We've got a lot that's happening. Hopefully for the good, but it could be for the bad, unfortunately. Um, so I want you to look at this turquoise line here at the very top. You're going to see it's connecting 2 points, the one on the left and the one on the right. That was supposed to be a circle, just use your imagination. But in any case, the point is with these 2 points here, we've tried to overcome this ceiling many times and we've gotten rejected, and so that has resulted in essentially the market usually getting suddenly, quite rapidly, worse and rates going up. This is probably the best interest rates have been for a while that you've seen. It's definitely the best rates have been since December of 2023, so almost a calendar year ago. The last time we saw rates this good was back in July of 2023, so a little bit over a year ago. And if you look at the bond history, what we're trying to break above was a huge line, or really a support level, for many points where the rates were getting worse. And the point of breaking this point is, all right, well, if we are able to get over this ceiling of resistance, this is going to be uncharted territory that we haven't been in really since getting back into 2022 and some of the times where the rates were the lowest. So overall, if we can break it, it's really good news if we do. The chances of that happening are not as high as I'd like it to be. And the reasoning for that, so remember, a ceiling of resistance is built, so the more we go against a ceiling of resistance and we fail to break it, it becomes a stronger and stronger ceiling. Essentially, there's going to be more pressure or harder to get over. And it works in reverse as well, that if we hit a level of support, well, the more times we bounce off that level of support, the stronger and stronger that level of support actually becomes. And so, for the simple fact that we haven't been able to break this particular ceiling since we've been in this downtrend of interest rates uptrend of interest rates going up, that's why it's unlikely that we're going to be able to break it. And if we don't break it, the volatility will be so extreme and aggressive that you could be looking at locking an interest rate for one of your clients, and the pricing, let's just use an interest rate of 6.5%, and the pricing, let's just call it 2,000. In the same day, that could jump to 699, costing 4,000. That's the point of where we're at right now when it comes to the volatility. Now, there's a lot of things that are coming up next week as far as the interest rate market is concerned. Some of the big things that are coming out are going to be, we have the FOMC meeting, which is the Fed's policy and their projections. We have oil coming out. We have retail sales. There's a lot of data reports is the point. Put it on the screen here so that way you can see what's coming out. But these are the most impacting data points for interest rates. And then let's also not forget that this is the fiscal year end for the Federal Treasury. For you and me, our tax returns end on 12/31. For the federal government, they end on September 30th. And this is usually when we see a lot of money policy change and the volatility go through extreme levels. So let's get back to the charts for a second, and this is where we start looking at the probability and the likelihood of it, what's going to happen. Essentially, whoever has the most points wins. So if there's 10 points on the board and someone has 9, well, obviously that person won, or that thing won. In this case, the odds of probability, well, this is the first indication that this is point number 1. Chances aren't good. Let's dive into the chart a little bit more in detail. Okay, so what we're looking at right now is divergence and convergence. Best way to describe this simply is it measures momentum, and it shows what direction we're going to be going, and if there's a reversal in trend. So I'm going to put a couple X's on the screen here, and it'll make sense why in a second. So these are 2 low points, 2 high points. I'm going to highlight this one, or put an X there for this third one, and a fourth one here. Now let's compare that to the pricing actually on the chart. Well, if we bring that up, sure enough, when the momentum reversed, rates got better. And when it reversed the other direction, rates got worse. And then here, better. I know there's a lot on the screen, but it's going up in price here. And then here, down. Here, better. And then here, started to reverse. Now if we zoom in for a second, this looks like it's about ready to come and do this kind of motion. Now that's a stretch at the moment because it's not really anywhere close. You would want to see these two lines really closer to each other before you could really say it's going to go ahead and reverse. So we need a couple more days of data to make that determination, which is going to play out next week. But the point is, it's not going straight up like it was here, right? You can see there's no pattern or evidence it's going to go ahead and cross right there. That's what we would want to see right here if we had a high chance probability of the upside. In this particular case, this would be another probability of probably not in our favor. So going back to the next piece, we're going to go to the RSI, which is the Relative Strength Index. Basically, the best way to describe this is going to be measuring let me get that pulled up. Okay, so this is the RSI, Relative Strength Index. Best way to explain this one is price confidence, or overbought, oversold. So when it's down here, price confidence in whatever the asset that you're looking at, it's not high. When it's up here, price confidence is super high. If you've heard the term FOMO, or fear of missing out, this is usually when most people are trying to get in. Oh, it's so high on the price, I want to buy right now. I don't want to miss out. And then when you're down here, this is usually what's called capitulation. This is usually when, it's never going to go back up. I'm tired of this asset. I don't want to be in it anymore. And this is when the most people usually sell, and then sure enough, it reverses. A lot of psychological aspects that go into this. But the point is that if we look at it in the most recent time, well, what we can see is we're above the median. And down here, this is 30%. Up here, this is 70%. And this is in the middle of those two. And so we hit this point as a support, and we're going back towards this direction. Now notice every high is higher than the last high. Okay, that would indicate that this potentially could go here. The question is, does it get over here before it gets overbought and there's a sell-off? But the point is, if we look at it from a probability standpoint, this would be an indicator, actually in the positive fashion, that rates are likely to get better. So now, if we go and look at all of it at once, and we look at what we're seeing on all three. Okay, our momentum says it could go either way. Our pricing says it can go either way, which is the candles, that's measuring the pricing. Our Relative Strength Index says it should go positive. And then we go back to the candles, that pattern that I showed you earlier in the video, and that was negative. So far we've got 3 no's, 1 yes. Odds are rates either will stay the same or get worse. And this is where the rate lock alert comes from. Again, overall, really positive news. There's a chance here that we could finally reverse course. But just be ready and be at your desk first thing morning on Monday next week in case you have something that's not locked and floating, because we could see some extreme volatility.